All right, so welcome to our deep dive. Today we're tackling Warren Buffett,
Warren Buffett.
but specifically his unreasonable investing. Kind of an interesting concept.
Yeah,
And we're going to be using the Warren Buffett way as our guide
perfect.
to figure out how ignoring the stock market could maybe actually lead to success. What do you think?
I love it. It's definitely not about following the crowd.
Right.
This is about how Buffett consistently beats the market.
Yeah.
And the book calls this the philosophy of the unreasonable man.
Okay, that's pretty intriguing. Unreasonable man. So the book actually starts with this quote
Oh, yeah?
by George Bernard Shaw. It says, "The reasonable man adapts himself to the world. The unreasonable one persists in trying to adapt the world to himself.
Right.
Therefore, all progress depends on the unreasonable man."
Love that.
So how does that actually relate to Warren Buffett and investing?
Well, when you think about it,
Yeah.
most investors, they try and predict the market,
Yeah.
right? They try and ride those waves, ride the trends. That's being reasonable or adapting to the
Right.
chaos. But Buffett, he kind of flips the script.
Okay.
He looks for those solid businesses, the ones he really understands.
All right.
And then he waits. He waits for the world, for the market to see, to recognize their true value.
So instead of being swept up in the next big
Right.
thing, like the dot-com bubble,
Exactly.
he just kind of waits it out.
He waits it out. And, think about those reasonable investors back in the late 90s.
Yeah.
The book talks about how they were chasing all those tech stocks, remember?
Oh, yeah.
And then the bubble burst and portfolios just crashed.
Crashed and burned.
But Buffett, he avoided all that hype,
Huh.
stuck to his principles, and he ended up outperforming pretty much everyone.
Okay, so I'm starting to see why being unreasonable might be a good thing,
Yeah.
at least in this context.
In this context,
But how does he actually choose those solid businesses? Does he have a secret formula?
not really a secret, but definitely a formula.
Okay.
You see, the real difference is that he sees businesses. He doesn't look at stocks. He sees businesses. And he's actually quoted in the book as saying, and this is a great one, he says, stocks are simple.
Okay.
All you do is buy shares in a great business.
Okay.
For less than the business is intrinsically worth,
Right.
with management of the highest integrity and ability, you own those shares forever.
Okay. That's a bold statement, but how do you figure out what a business is really worth?
Yeah.
The intrinsic value.
Right.
It's got to be more than just looking at stock price.
Oh, absolutely. Intrinsic value, it's like a company's true north,
Okay.
It's what it's actually worth based on its future, its ability to make money, cash flow
Yeah.
down the line.
So it's about the future.
Yeah, and Buffett he's not distracted by all those little ups and downs in the market.
Right.
He's looking ahead.
Okay.
He's calculating the present value of all that future cash a business can generate. So that's how he knows when a stock is a steal, even if everybody else is selling it off.
So it's not just crunching numbers. It's really understanding the long-term potential.
It's a long game. Exactly.
Yeah.
And that's what brings us to another big idea. The book talks about how Buffett, he just tunes out the noise, all the noise of the market. Doesn't get distracted by prices changing every day or the flavor of the week,
Right.
There's this great story about him not even having a stock quote machine
Wow.
in his office.
That's pretty radical, especially today when we're just bombarded with financial news.
Yeah.
So how does he do it?
Well, the book, it lays out 4 key steps.
Okay.
First,
Yeah.
turn off the stock market.
Okay.
Don't get caught up in all those daily ups and downs. Second, don't worry about the economy. Focus on those businesses that can thrive no matter what's happening.
Okay, so the first 2 are about just blocking out distractions.
Exactly.
So what are the next 2?
These are the good ones. So step 3, buy a business. Don't just buy a stock.
Okay.
Remember, you're not just buying a piece of paper. You're becoming an owner.
Right.
You're owning a company. Choose wisely.
Okay.
And finally, number 4 is to manage a portfolio of businesses, not a collection of, stock tickers. Think like you're a business owner, not a stock trader.
Okay, so I think I'm starting to get the big picture here.
Yeah.
But let's dig a little deeper into that whole buying a business thing.
Okay. Yeah.
What specific things is he looking for?
So he wants simplicity.
Okay.
He wants things that are easy to understand.
Yeah.
He famously avoids things he doesn't get.
Right.
He also wants honest and competent management
Yeah.
because the people in charge. They're key. They need to know how to use money well, to allocate capital, and they got to have a proven track record.
So it's not just the numbers, it's the people behind the company.
It's the team, exactly.
Yeah. Okay, what else is he looking at?
So, of course, the financials have to be solid, healthy profit margins, consistent cash flow. But the real kicker,
Yeah.
he only buys when a company is on sale, like way below its intrinsic value. That's how he builds in that margin of safety.
Okay, now that margin of safety, that sounds important. Can you break that down a little more?
Yeah, so it's all about buying a company for less than it's worth.
Okay.
It's like, think of it as a buffer.
Okay.
If you buy $1 for 50 cents, even if you're a little off in your calculations, you're still ahead of the game.
I like that. That's a great analogy.
Yeah.
It seems like patience is a really big part of all of this, right?
Yeah.
Waiting for the right moment to buy at that discount.
Absolutely. He's not in any rush. And the book actually highlights how much he believes in patience and focus. He's willing to wait for that perfect opportunity, and then, boom, he goes all in.
Wow.
He's not about spreading himself thin. He wants quality, not quantity.
Right.
A concentrated portfolio of companies he really, really knows.
So he's not trying to catch every trend. It's about finding those few, like, exceptional businesses.
The gems.
And holding on.
And holding, exactly.
Wow.
It all comes down to rational capital allocation.
Yeah.
He invests where he sees the biggest potential for growth, long-term growth.
Yeah.
Doesn't get distracted by the fads or the hype, just sticks to his philosophy, even when the market's going haywire.
That's a good lesson for anybody, right?
Yeah.
Not just investors.
Yeah.
Okay, so let's look at some real-world examples
I love it.
from the book that show how he puts this into practice.
Okay.
The first one that comes to mind is the Washington Post.
Oh, yeah. The Washington Post.
That was a big one.
That's a perfect example of his contrarian style, you know? He saw an opportunity to buy a great business when everybody else was undervaluing it.
So he was going against the grain.
He was. He wasn't swayed by all the negativity around the company at the time. He saw the strength, you know, the brand, the potential, the long-term growth, even though the market was down on it.
So he swooped in and got a bargain while everybody else was panicking.
Pretty much.
That takes guts. Tell me another one.
Okay, so another good one is Wells Fargo.
Oh, Wells Fargo. That's the name we've heard a lot lately.
Yeah.
Not always for the best reasons, though.
Right.
So what was he thinking back then?
So back then, they were facing some issues, some risks in the California real estate market, and the market was just punishing the stock because of these risks, you know.
So like with the Washington Post, everyone was just afraid of the company.
Exactly. But Buffett, he saw through it. He saw those temporary setbacks, and he knew that their core business, that was still strong.
So again, he bought when everyone else was selling.
He did. He had the conviction to go against the grain, to invest in a company he believed in.
Whoa.
Even when everyone else was running away.
And it paid off.
Oh, big time.
Okay. And we can't talk about Buffett without talking about Coca-Cola.
Oh, of course.
One of his biggest wins, right?
A classic.
What's so interesting about that is it was, and still is, a simple business.
It's a simple business. It's a drink.
It's a beverage company.
Yeah, with the global brand.
Right.
And everybody loves it.
So he wasn't, looking for some flashy tech company or the next big thing. Well, he saw the value in Coca-Cola.
The enduring value.
Absolutely, even though it was, kind of boring.
A little bit, yeah.
Compared to some of the other stuff out there.
But he saw the power of the brand, the moat, and that potential, to make money consistently for years and years.
For decades.
And
it was a classic Buffett play.
A classic Buffett play.
It's really interesting seeing it all come together, with those examples.
Yeah, for sure.
It's clear he's not afraid to wait, to be patient, to trust his gut, even when the market's saying something else.
Yeah, you could say that having the right temperament, it's just as important as having the analytical skills.
Temperament. So it's not just about being good at math. It's more about the mindset.
Exactly. He really stresses patience, discipline, emotional detachment.
Okay.
He's not easily swayed by fear or greed.
Yeah.
Which, they're the things that drive those short-term market swings.
Right. Okay, that makes sense. But how do you actually develop that kind of temperament?
Yeah.
It's easy to get caught up in the excitement or the fear.
Especially as your own money.
When it's your own money.
On the line.
Yeah, for sure. It's definitely a process.
But I think one thing that can help is to shift your focus to what the book calls owner earnings.
Owner earnings. Okay, that's a new one. What's that about?
So it's basically a way to look beyond just the traditional numbers, the accounting stuff,
Okay.
and to see how profitable a business really is.
Okay.
It's about understanding, how much cash a business can make for its owners, which at the end of the day is what matters most to Buffett.
So it's not just about looking at the bottom line, the net income.
It's deeper than that.
Okay.
Owner earnings take into account things like capital expenditures, changes in working capital, to give you a more accurate picture
Okay.
of a company's ability to generate cash.
So it's like looking under the hood.
Exactly.
To see the real engine of the business.
I like that.
Yeah.
I like that.
Okay, so the book also spends a lot of time on the management team.
The management team.
Why does Buffett put so much emphasis on that?
He actually said this great line. He said, "I try to buy businesses that are so wonderful that an idiot can run them,
Okay.
because sooner or later one will."
Okay, so even if you've got a great business model, bad management can just ruin it.
They can wreck it.
Right.
Yeah, he looks for managers who are, honest and competent.
Yeah.
And aligned with the shareholders.
Mm-hmm.
They need to be good at allocating capital, making decisions
Right.
that are going to benefit the business over the long term.
So you've got to look at the people, not just the numbers.
It's the team.
Yeah. It's like investing in a team.
Exactly.
Okay, so where do you even start looking for these Buffett-worthy companies? It's not like they're just sitting there with the big sign, invest here.
Yeah, right.
What do you think? Where do you start?
Well, the book actually suggests starting with what you know.
Okay.
Like, think about your own experiences, the products and services you use, the industries you're interested in.
Okay.
Buffett, he often invests in companies that are pretty straightforward, easy to understand.
Okay, so don't overthink it.
Yeah.
Start with what you're familiar with.
Exactly. So if you're a big coffee drinker,
Yeah.
maybe take a look at some coffee companies.
Okay. Yeah.
If you're into tech, explore those leading tech companies.
Nice. Right.
The key is to start with what you know and then do your research.
Okay.
Read those annual reports,
Mm.
study the industry, and try to figure out what are their competitive advantages.
So applying Buffett's ideas
Yeah.
to areas where you already have some knowledge makes it a little less scary.
Less
Yeah.
intimidating, for sure.
Yeah. Okay, but what about actually managing the portfolio? Does he have any advice on that?
Oh, he does. He does.
Okay.
And this might surprise you.
Okay.
He's not a fan of diversification.
Wait, really?
Yeah.
I thought that was like the golden rule.
I know, right?
Don't put all your eggs in one basket.
Yeah, that's what everybody says.
Right.
But Buffett, he sees it differently.
Okay.
He says that if you've done your research and you've got a few, killer ideas,
Mm-hmm.
you don't need to spread yourself thin.
Okay, so it's about having conviction
Conviction, exactly.
and focusing on those best ideas.
He calls it focusing your investments.
Mm.
He believes that, a smaller portfolio with your very best ideas,
Okay.
that has the potential to beat a bigger one filled with just mediocre picks.
That's pretty bold.
It is bold.
It requires you to be really sure of your analysis,
Yeah.
but I can see how the payoff could be bigger.
The potential is definitely there.
Yeah. And that brings us to another key part,
Okay.
risk management.
Risk management.
He seems to be really risk averse.
He is, very much so.
But isn't all investing risky? I mean, the market's unpredictable.
Oh, totally.
Right.
Yeah, but you see, Buffett's approach,
Uh-huh.
it's all about avoiding risk in the first place.
Yeah.
And he does this by investing in companies with what he calls wide moats.
Wide moats, like a castle.
Like a castle, exactly.
Okay.
He wants businesses that are hard to compete with.
Hmm.
They have a sustainable advantage.
Okay.
Could be a strong brand,
Mm-hmm.
unique technology, loyal customers,
Okay.
something that makes it hard for competitors to come in and steal their market share.
So by investing in these companies with the moats,
The most.
he's trying to protect his investment.
Yeah, reduce that risk of competition.
That's a very defensive strategy.
It is. He's not swinging for the fences every time.
Right.
Carefully picking those businesses he thinks can stand the test of time.
Like building a portfolio that can weather any storm.
Yeah, I like that.
Yeah. Okay, so let's talk valuation.
Okay.
How does he decide what the right price is for a company?
Well, he's a master at figuring out what a company's actually worth.
Yeah.
It's intrinsic value. He looks past the stock price. He's trying to see what the business is truly worth
Okay.
based on its future earnings.
So it's not just about what the market is saying.
Right.
It's about doing your own analysis, coming up with your own valuation.
Your own homework.
Yeah.
Yeah. And Buffett's known for his patience here, you know.
Okay.
He's not afraid to just wait.
Okay.
If he doesn't see anything he likes,
Mm.
he's not pressured to jump in on every hot stock or sector.
Right.
He's waiting for that perfect pitch.
Right. He's waiting for the right pitch.
He actually compares the stock market to a department store.
Okay.
He says you don't have to buy something just because it's on sale.
Right.
Wait for the things you actually want.
Yeah.
Wait for the things you need and be willing to walk away if the price isn't right.
That's a great analogy. I like that.
A good one.
Okay, now, the book also talks about his view of the stock market itself. And it's a little surprising. He doesn't seem to be that obsessed with it.
He's not. He sees the market as a tool, not a master.
Okay.
He uses it to buy and sell businesses, but he doesn't let those, daily ups and downs control his decisions.
So he's not glued to the ticker trying to time the market.
He's not. He's actually said, he wouldn't be bothered if the market closed for a year or two.
Wow.
He's focused on how the businesses he owns are performing, not just, what their stock price is doing on any given day.
Right. That really changes your perspective. It's not just about the daily game. It's about
It's a long game.
Yeah. Owning a piece of a business.
Exactly.
And sharing in its success.
Owning a piece of something real.
Yeah, exactly. Okay, so let's move on to another key aspect.
Okay.
Capital allocation.
Capital allocation.
That sounds like,
Yeah.
a big company thing.
Right.
How does that apply to us,
Yeah, good question.
regular investors?
So it's all about deciding how to use your money
Okay.
most effectively. Buffett's a master at this.
Yeah.
He's always looking for the best use of his capital.
So it's not just about making good investments. It's about making sure your money is working as hard as it can.
In the right places.
In the right places.
Yeah. It takes discipline, it takes analysis, and that long-term perspective.
Right.
It's about making smart decisions, not, emotional ones.
So he's not an impulse buyer.
Not at all.
Okay. Now, given that he's so focused on the long term and consistent returns, I'm wondering about his view on leverage.
Leverage?
Isn't that a way to really boost your returns?
It can, but it can also make your losses bigger.
Oh, right.
Yeah. And remember, Buffett is very risk averse.
He is.
He generally stays away from using leverage.
Okay.
He'd rather invest with his own money.
So he's not into borrowing money to invest.
He's not a big fan. He did say, and I love this quote, he said, if you're smart, you don't need it.
Okay.
And if you're dumb, you shouldn't be using it.
So it seems like his philosophy is really about building wealth steadily.
Slowly and steady wins the race.
Yeah.
That's right.
And not taking those unnecessary risks.
He's not a gambler, He's a value investor. He's in it for the long haul. And that brings us back to temperament.
Temperament, yeah.
He stresses this so much. Keeping your emotions in check.
Okay.
When you're investing.
Easier said than done, right?
For sure.
So how do you stay calm when the market's going crazy?
Yeah, it's tough. But the book suggests focus on your goals, those long-term goals.
Okay.
Tune out the daily ups and downs.
Or noise.
The noise, yeah.
Okay.
And stick to your plan. Remember, the market will always go up and down.
Right.
But if you've chosen you've invested in good, solid businesses, those fluctuations, they shouldn't scare you.
So it's about trusting your analysis and not panicking.
Not panicking, exactly.
When things get a little rocky.
Ride the waves.
Yeah. Okay. The book also talks about continuous learning.
Lifelong learning.
Is Buffett out there studying new investment techniques?
Not so much about specific techniques.
Okay.
More about just learning, expanding his knowledge, understanding the world.
Okay.
He's a big reader.
Yeah.
Talks to people in different industries. He's always open to new ideas.
So it's about being a lifelong learner, constantly trying to improve your understanding.
Of business, the economy, everything.
Everything, yeah.
Yeah.
Okay. So he's not afraid to admit when he's wrong or to change his mind.
He's not. He sees learning as an ongoing thing.
That's a great lesson for anybody.
Yeah, for sure.
Okay, so given his success, I'm curious about his view on on luck.
Luck.
Yeah. Does he think luck plays a role?
He does acknowledge that luck can be a factor
Mm-hmm.
in anyone's success.
Okay.
But he also believes you can make your own luck
Oh.
by
Yeah.
working hard, being prepared,
Hmm.
staying open to new opportunities.
So it's not about just sitting around
Right.
waiting for something good to happen. It's
Yeah.
about being ready.
It's about positioning yourself
Yeah.
to take advantage when that luck strikes.
Okay, so working hard,
Yeah,
being prepared.
absolutely.
That's how you
That's how you make your own luck.
create your own luck.
Yeah.
Okay. Now, beyond investing, the book also gets into his philanthropy.
Is giving, yeah.
He's known for being incredibly generous.
Oh, incredibly generous.
Right.
He's one of the most generous people in the world.
So it's not just about,
Right.
making money. It's about
It's about giving back.
giving back.
Yeah. He believes that if you've been lucky enough
Yeah.
to be successful,
Mm.
to have that financial success, you have a responsibility
Yeah.
to give back.
So it's not just about accumulating wealth. It's about using it to make the world a better place.
To make a difference.
Yeah, to make a difference.
And you know what? His philanthropy, it's driven by the same things that drive his investing.
Oh, okay.
Integrity, rationality, that
Mhm.
long-term vision.
Okay, so it's all connected.
It is.
Yeah.
Yeah.
Now, what about his definition of success?
Success.
Because
Yeah,
the book talks about that.
it does.
And it's not what you might think.
It's not about the money.
It's not.
He doesn't define success by wealth or status.
Okay.
He believes true success is about finding something you love,
Okay.
something you're passionate about,
Mhm.
and being really, really good at it.
So it's about pursuing your passions
Yeah.
and making a contribution that you find meaningful.
And doing it well.
Yeah.
That's the key.
Okay, so the money, the financial success, that's just a byproduct.
A byproduct of doing what you love.
Yeah.
Exactly.
That's really inspiring.
It's a good perspective.
Yeah, and it goes back to that integrity piece.
Integrity, yeah.
He always says he looks for 3 things in the people he works with. Intelligence,
Intelligence, energy,
energy, and integrity.
integrity. He believes it's essential
Okay.
for long-term success.
Okay, so being honest,
And
ethical.
being a good person.
Yeah. That seems to be a real,
A theme.
a theme throughout
It really is.
his approach.
Yeah, and it's reflected in his personality,
Oh.
Very down-to-earth guy.
Okay.
He avoids all that extravagance.
Mhm.
He's known for being frugal.
So he's not about, like, showing off his wealth.
Not at all.
Okay.
He lives a simple life.
So he's not about the fancy cars, the big houses.
Nope. He sees frugality as a virtue,
Okay.
as a way to build wealth, achieve financial independence.
It's a good message.
It's a good message.
Especially in a world that's so focused on,
Conspicuous consumption.
Yeah, exactly.
All that stuff.
Okay, now, the book also talks about mentors.
Mentors.
Yeah. And it seems like they played a big role in his life.
Huge role. He credits his mentor, Benjamin Graham,
Okay.
with shaping his whole philosophy.
So it's not just about being self-made.
No.
It's about recognizing that we can learn
Learn from others.
from others.
He believes having a good mentor
Yeah.
can be so valuable, especially early on in your career.
Yeah, having someone to guide you.
Someone to share their wisdom, their
Yeah.
experience, and their guidance.
Okay. And it seems like Buffett himself
Yeah.
has become a mentor to a lot of people.
He has, through his writing, his speeches, his example.
Through his actions.
He's incredibly generous with his time
Uh-huh.
and his knowledge. He believes in paying it forward.
Okay. Now, speaking of generosity,
Yeah.
the book also highlights his incredible work ethic.
Oh, yeah. He's a workhorse.
He's known for putting in the hours.
Long hours.
Yeah.
He believes that hard work
Uh-huh.
is essential
Okay.
for achieving anything worthwhile. No shortcuts.
No shortcut.
No easy money.
Okay, so it's about putting in the effort.
The time, the
Yes.
dedication
Yeah.
to really
master your craft.
to master your craft. That's a good message.
It's a universal message.
Yeah, for anybody.
For sure.
Okay, so we talked a lot about his successes,
Yeah.
but I'm curious how he views failure.
Failure.
Has he ever talked about how he handles setbacks?
Oh, yeah. He sees failure as just part of the process,
Okay.
He said you can't be a good investor without making some mistakes. The key is to learn from those mistakes
Okay.
and to not let them, get you down.
So it's about being resilient.
Resilient, that's the word.
Yeah.
Bouncing back.
Bouncing back.
And being able to see those mistakes
Yeah.
as learning opportunities.
Okay. He's actually said he likes to make his mistakes early.
Early and cheaply.
And cheaply.
Yeah.
That's the key.
So it's about minimizing the damage.
Minimizing the damage when things go wrong.
When things go wrong.
Yeah. He doesn't want to lose big.
Correct.
He wants to learn from those early mistakes.
So his whole approach
Yeah.
is about minimizing risk, maximizing those long-term gains.
That's a great way to put it.
Yeah. Okay. Now, the book also talks about reading.
Reading?
He's a big reader.
Voracious reader.
Yeah.
Yeah. So it's not just about, numbers and spreadsheets.
Okay.
It's about reading widely,
Okay.
expanding your knowledge.
Okay, so he's not just reading, like,
No,
finance books.
he reads everything. Newspapers, magazines,
Okay.
biographies, history.
Hmm.
He believes reading is the best way
Okay.
to learn about the world
Okay.
and to develop, your critical thinking skills.
Okay, so always be learning.
Always be learning.
Yeah. Yeah.
He applies that to his investing, too.
Okay.
He's always looking for new insights,
Okay.
new ways to improve his process.
So, given that long-term perspective,
Yeah.
I'm guessing he has some thoughts on trying to time the market.
He's famously said that he has no idea what the market's going to do tomorrow or next week
Right.
or next year.
Right.
He's just focused on finding those good businesses and holding on to them.
Okay, so it's not about trying to predict the short-term moves.
Not at all.
It's just about riding it out.
Ride the waves.
Yeah.
He believes that time in the market
Okay.
is more important than timing of the market.
That's a good one.
It is.
Yeah, it really emphasizes that patience is key.
Patience is key.
Okay. Now, another interesting thing the book talks about is simplicity.
Simplicity.
Isn't investing supposed to be, like, complicated,
Right.
sophisticated?
Yeah, a lot of people make it that way.
Right.
But he believes that, the best investment ideas, they're often the simplest ones.
Okay.
He's looking for businesses that are easy to understand and that have a clear advantage.
So it's not about, like, trying to outsmart the market.
No,
It's about
understanding
understanding.
the fundamentals.
Yeah.
He actually has a great rule.
Okay.
He says if you can't explain it to a 10-year-old,
Okay.
you probably don't understand it yourself.
That's a good one.
It is a good one.
Yeah.
It makes you really simplify it,
Yeah.
boil down.
Yeah. It forces you to get to the core
Exactly.
of the idea. Okay, so that brings us back to
Circle of competence.
circle of competence.
Knowing what you know
Knowing what you don't know.
and what you don't know.
Yeah, and being okay with saying, I don't know.
Exactly. He said many times he doesn't invest
Yeah.
in things he doesn't understand.
He sticks to his lane.
He sticks to his lane. He knows what he's good at.
Yeah. Okay, now I'm curious about his view on independent thinking.
Independent thinker.
Because he's clearly someone
he is.
who doesn't follow the crowd.
He's a contrarian.
He is.
Yeah. He believes the best investors
Yeah.
are the ones who think for themselves
Mm.
and who aren't afraid to go against the crowd.
So it's about having the courage
The courage
Yeah.
to challenge the status quo.
or challenge the status quo, to form your own opinion.
Your own opinions, exactly.
He often says you can't buy what everyone else is buying
Right.
and expect to beat the market.
You got to find your own edge.
Yeah, your own edge. Okay, so that edge often comes from
Yeah.
seeing things differently,
Seeing things differently.
challenging assumptions,
Absolutely.
and even being willing to be wrong.
Being okay with being wrong.
Right.
It's part of the process.
Okay, so his contrarian approach,
Yeah.
it's not about just being, rebellious.
Oh, it's not about
It's
that.
about being,
It's about thinking,
yeah,
analyzing,
being independent.
being independent in your thinking.
Yeah, okay. Now, given his wealth, I'm interested in his view on frugality.
Frugality. Yeah, he's actually famous
Right.
for living simply,
Okay.
not being flashy.
He's not about the lavish lifestyle.
Not at all. He lives in the same house he bought back in 1958.
Wow.
Drives a, pretty normal car.
So he's not showing off his money.
He doesn't believe in that.
Okay.
He sees frugality as a key
Okay.
to building wealth,
Yeah.
being financially independent.
It's a good message, especially in a world that
I know, right?
glorifies all the fancy stuff.
All the bling.
Yeah, the bling.
But it's about intrinsic value, not just in business, but in life.
In life, yeah, that's a good point.
He values experiences over things.
Okay.
He finds joy in the simple things.
Yeah, that's great.
Yeah.
Now, we talked about patience, but the book also talks a lot about focus
Focus.
when it comes to investing.
He believes that focus is crucial for getting those amazing returns.
Okay.
He says, he likes to swing for the fences when he sees a great opportunity.
So he's not afraid to go all in.
He's not. He's said many times, diversification, it's a protection against ignorance. If you really understand what you're doing.
Yeah. You don't need to spread yourself so thin.
Exactly.
So it's about having conviction in your analysis.
Conviction.
Yeah.
And not being afraid to really put your money where your mouth is.
Go all in when you see something special.
When you see that once-in-a-lifetime opportunity.
Yeah, yeah. Okay, so we've covered a lot of his strategies.
A lot.
But I'm curious about his overall view of risk.
Okay, risk.
How does he define it, in terms of investing?
Well, he's said it many times. He says risk comes from not knowing what you're doing.
So it's not about avoiding risk completely.
No.
It's about understanding the risks you're taking. Then using knowledge and analysis to kind of mitigate those risks.
Yeah, exactly. He believes the best way to reduce risk is to invest in businesses you get. Businesses that have a strong advantage.
So do your homework.
Do your homework.
Be selective and don't invest in things you don't understand.
Don't go outside that circle of competence.
Yeah.
Right?
Stay in your lane.
Stay in your lane.
Okay. Now, he's been so successful for so long.
Decades.
I'm sure he puts a lot of weight on track record.
Oh, yeah.
When he's looking at investment.
He does. He's been a successful investor for over 70 years.
Wow.
And he really believes that consistency, performing well over time.
Yeah.
That's the real indicator of skill.
So it's not about, chasing the hot stock.
Nope.
The quick buck.
No get-rich-quick schemes.
It's about showing those steady returns.
Year after year.
Year after year.
Yeah. And that consistency.
Yeah.
That really speaks to his discipline, his patience, his commitment to his principles.
That's really impressive. Now, one last thing I wanted to touch on is temperament.
Temperament. It always comes back to temperament.
It does.
Doesn't it?
It really does. It seems like it's such a crucial part of his success.
He says it's more important than IQ when it comes to investing.
Wow. So it's not just about being smart. It's about having the right mindset.
The right mindset, the emotional makeup.
To handle all those ups and downs.
To ride those waves.
Yeah, yeah. Okay, so he's always emphasizing patience, discipline.
Emotional detachment.
Okay. That makes sense.
Yeah.
It's hard not to get emotional when it's your money.
Oh, I know.
But his approach is about staying calm and rational.
Rational, even when everyone else is losing their minds.
Yeah, yeah. He's got that famous quote, right?
Oh, yeah. Be fearful when others are greedy.
Yeah.
And greedy when others are fearful.
So basically, think for yourself.
Think for yourself.
Don't follow the crowd.
Don't follow the herd.
Okay, but how do you actually develop that kind of temperament? It seems almost impossible.
It takes practice. It's about understanding your own biases, learning to control those impulses,
right,
and really, really developing that long-term perspective.
So it's about mastering your emotions.
Mastering your emotions.
Yeah.
Not letting them, cloud your judgment.
And remembering that the market's not a casino.
That's right. It's a place to invest in businesses.
Yeah.
Not to gamble.
Not to gamble. Wow, this deep dive has really given me a whole new understanding of Warren Buffett's approach.
It's really a philosophy.
It is.
Isn't it?
It's not just about,
It's not just about picking stocks.
Picking stocks. It's a way of thinking.
It's a way of life.
It is.
It's about thinking clearly, being patient, being disciplined in everything you do.
And I'm really struck by how many of his principles they apply to life in general.
They do.
Not just investing.
Absolutely. That long-term thinking, the integrity, always learning, those are valuable lessons
for everyone.
For everyone, no matter what you do.
So as we wrap up here, what's the one big takeaway you want listeners to remember? What's the essence of the Warren Buffett way?
I think it's understanding that investing, it's not about beating the market. It's not about getting rich quick.
Okay.
It's about owning those great businesses.
Okay.
And sharing in their success.
It's about looking beyond just the stock price.
Exactly.
To the real value of the company.
The fundamentals.
Yeah.
And it's about having the patience, the discipline,
the
temperament to stick with your plan.
Even when everyone else is panicking.
Even when everyone else is going crazy.
It's about being that unreasonable man.
The unreasonable man.
Seeing the value that others miss.
And being willing to wait for everyone else to catch up.
We've learned so much today from The Warren Buffett Way.
It's a great book.
What are some other resources that listeners can check out?
Yeah, so definitely check out The Intelligent Investor by Benjamin Graham. That was a big influence on Buffett. Also, the works of Phil Fisher. Another legend. And, of course, Buffett's own letters.
His letters,
to Berkshire Hathaway shareholder.
Those are great.
Full of wisdom.
Yeah. And I encourage everyone, don't just read about it.
Right.
Go out there and actually apply these principles to your own life, to your own investing.
Start small. Do your research. Be patient. And don't be afraid to make mistakes. Yeah.
Learn from them.
It's all part of the process.
This journey.
It is.
This is.
Not a destination.
The more you learn, the more you realize you don't know.
That's so true.
Isn't it?
That's a great place to end it, I think.
Yeah.
Keep learning, keep exploring, keep diving deep. And maybe one day, you'll be the next Warren Buffett.
That's the goal.
Until next time, happy investing.